Good day. This is Jeffrey Cleveland from the Payden Economics Team with your economic review and outlook for the month of April 2021. We're calling it Reopening 2.0, and there are really three key macro themes right now. The grand reopening of the global economy due to excellent progress on vaccinations, the what we think will be an inflation scare in the next couple of quarters, and the fact that central banks will not react to that pickup in prices that we expect. Central banks will sit on their collective hands and not adjust monetary policy in 2021. So let's walk through each of those themes quickly. First and foremost, global grand reopening. We see excellent readings on the real-time indicators of economic activity out of the US, China, and even the Eurozone. This is a chart of purchasing managers' indices. These are the composite indices, so they are tracking services sector activity and manufacturing activity. You can see the U.S. economy leading the way so far this year. That's consistent with the U.S. economy outperforming its developed peers, growing at, we think, a 7.4% rate in 2021. The global economy will not fare too badly, though. We expect 6% world growth in 2021, and we expect 4% growth out of Europe. You can see Europe did stumble in Q4 and at the start of 2021, but activity indicators on both the services side and the manufacturing side in Europe have moved into positive territory in the last month or so. So this is excellent news, and we expect that to continue as the year progresses. So the world is reopening. With it, though, we think will be a frenzy of spending, and that will boost prices. We are already seeing that show up in spending activity and in prices for things from everything from lumber to hotel stays to airfare to used car prices. So we expect this to be a theme over the next couple of months, and that could cause an inflation scare for the financial markets. Investors will see prices spiking. They will think, well, this is inflation. We would caution against jumping to that conclusion. You can have price spikes as the global economy reopens, demand comes back, and then we will have some bottlenecks on the supply side. That's what we're seeing right now, for example, with rental car prices in places like the Hawaiian Islands, people going on vacation, not enough rental cars, prices are spiking. The economy, the supply chains will sort themselves out over the next year, and demand, I think, will fade a little bit. It will be a reopening, a frenzy, and then things will calm down, and so too will prices, such that we will get to a year from now and core measures of inflation, like you're seeing here, the core PCE, will probably settle back down closer to 2% year on year, or maybe a bit less. So a temporary spike in prices, a temporary pickup in core measures of inflation like core PCE and core CPI, but things will settle down. It will be temporary. It will be transitory. And because of that, central banks know it. They're expecting it. They will do nothing. We expect the Fed to sit on its hands, to keep overnight rates at zero, and to continue purchasing assets throughout 2021. The bond market, though, will probably see the excellent economic data come out over the next few months and then question whether the central bank will actually stick by its commitment to keep rates low. And we've seen that story sort of play out in the last couple of months. We're showing you here on this chart the dots, the famous dots. These are the projections by the members of FOMC as to where they see the overnight rate at the end of 2021, 2022, and 2023. Those are the blue dots. We're comparing those blue dots to the green square. The green square is the bond market implied rate for overnight rates at the end of 21, 22, and 23. And you can see the square creeping up there. So there's one rate hike priced in 2022, and there was 2 rate hikes priced in for 2023, so a total of 3. And just by looking at this, you can see that the square is above the vast majority of the dots. So our gut tells us that the bond market got a little bit ahead of itself. The Fed probably, a lot of things need to happen between now and the first rate hike. So the Fed probably will not hike rates until late 23, maybe even later than that. So that is the summary For the month of April, the reopening is underway. It's a global reopening. We expect very strong economic data as the year progresses. With that, though, we expect a frenzy of spending, which will boost prices across a lot of different product categories. That will probably spook the financial markets, a bit of an inflation scare, but we think it'll be temporary and prices will settle down as we get closer to the end of the year and into next year. And that will probably disappoint central bankers. They want inflation to be at or above their target, and they will end up a year from now probably with inflation on core measures at or below target. And so they will maintain easy monetary policy, so no rate hikes, at least not based on what the market is currently expected. Rate hikes will arrive later, and there will probably be fewer than expected. All right, that's the summary for the month of April. I hope everyone is doing well and stay healthy.